Welcome to the Cardinal Commentary for the Canadian equity portfolios. What a difference a year has made for the Canadian economy. At the start of 2024, the Bank of Canada's overnight rate sat at 5%. But thanks to 5 cuts from June to December, plus one more early in the new year, it's now down to 3%. Lower interest rates, of course, have a significant impact on what consumers pay for all kinds of debt, including mortgages and car loans. Inflation has followed a similar path. A year ago, the Consumer Price Index was at 2.9%, but it moved steadily downward throughout 2024 and hit 1.8% in December. That's just below market expectations and the Bank of Canada's target rate. Keep in mind, it's also down from a 40-year high of 6.8% in 2022. At the same time, the Canadian stock market grew steadily, with the S&P TSX finishing the year up nearly 22%. President and Chief Investment Officer Evan Maner says our Canadian portfolios did even better than that.
We knew we were in an interest rate cutting cycle. The recession never happened. The economy has been pretty strong. And so we've actually had a very strong year in markets. TSX was up almost 22%. In the US, it was up 25%, which is closer to 35 in Canadian dollars. And the Cardinal portfolios did quite well. We were ahead of the Canadian market, a little bit behind the S&P 500, and kind of right on the money with the Canada Plus portfolio.
And those returns are a reflection of the more than 24 companies in our Canadian portfolios that increased their dividends in 2024, led by Boardwalk REIT, Brookfield Corp, and Gildan Activewear. In fact, 5 of our holdings increased their dividends twice in the span of just 6 months. We believe the bull market is going to continue, and Maner is calling for a 15% return in 2025. He backs it up with 45 years of history. Since 1980, the stock market has gone up 80% of the time, and in 21 of those years, it has appreciated by at least 15%.
When clients ask, should we get out of the market, should we stay in, our advice is stay in, be on the right side of a good bet. The 15% call, actually, most strategists will say, 10% if they're positive on the market, because that's been more the long-term return. If you actually look at the data in those 45 years, almost half the time, the market's gone up over 15%. And given that we're positive, because if you look at the 20% of the time when markets are down, it's almost always accompanied by an interest rate hiking cycle or a recession or both. And we don't see those happening, so we're positive. And so we might as well pick 15% as the average.
Strong returns over the short term are nice, but our Canadian portfolios continue to outperform when it really matters, like over 15 and 25 years. And here's the proof. If you had invested $500,000 in the Cardinal Canadian equity portfolios in 1993, it would be worth more than $12 million today, outstripping the benchmark by more than $5 million. And all of this demonstrates our commitment to clients, a common sense path to long-term wealth. Because it works. And that's the Cardinal Commentary for the Canadian equity portfolios. Thanks for joining us.